Hello, good morning, good afternoon, and good evening to all of you from wherever you're joining in from. Welcome to our masterclass. Today's topic is minimize bad debts as pandemic stimulus fades. And we have with us John Salick, our masterclass subject matter expert at Emagia. And John is the strategic AR advisor, and he is going to be taking us through the session now. John, over to you. Thank you very much.
Thank you, Akshay, and welcome everyone. Thanks for joining. Got an interesting program today. A little bit of a look ahead to next year, which since it's mid-December and next year is 2 weeks away, kind of makes sense. Maybe we're a little late. Anyway, we'll introduce the topic, kind of set the stage. We'll talk about the need for proactive credit management next year to deal with threats, elevated credit risk. But in addition to threats, there will also be some opportunities, as is always the case. So we'll talk about those as well. And then we'll get into solutions. And the solutions are process as well as technology, very much within the realm of practicality. Then we'll share with you 2 case studies today that I think are very interesting and very relevant. Sum up the benefits, wrap it up with a conclusion, and then answer any questions you have. So let's start off here. The emergence from COVID-19 is, well progressed, almost complete. Certainly in the US, the unemployment, which was once high double digits, is now down to 4%. All the indicators are near their pre-pandemic levels. Some are even exceeded them. So the emergence is well progressed. However, there's still some threats out there. As the pandemic stimulus provided by the government starts to wind down, and it already has, as the debt forbearance, the mortgage repayment forbearance fades, that'll raise a threat throughout the economy. Overall levels of debt and mortgage and housing have really a big impact on the economy, even more so perhaps than any other sector. So we're getting a decrease in support there. Retail sales, of course, after the holiday rush, which doesn't appear to be peaking like in past years, but that's going to ramp down starting in January. And then, of course, the rise in interest rates, which was solidified yesterday in the announcement from the Federal Reserve saying that they're cutting back on their stimulus, and they're also planning 3 interest rate hikes in 2022. So there you have it. Bank of England, along the same lines. The European banks, not so much, cutting back on one stimulus, renewing another, and no foreseeable interest rate hikes. But anyway, the threats are there. As a result, 2 of the larger credit insurance providers, Atradius and Euler Hermes, forecast a significant increase in bankruptcies for next year. These estimates vary, 33% for Atradius, 15% for Euler Hermes, but I think the message is pretty clear. And then the other thing you need to think about, particularly if you're selling to smaller companies, smaller customers, the good news of the last 2 pandemic years is that business startups have increased significantly. Over 5 million in this calendar year and somewhat similar in 2020. So good news, right? Well, remember, about a third of them fail within their first 2 years. So if you are selling to new startup companies, there's going to be a pretty high default rate there. So there's definitely threats out there despite the overall improvement in the economy. And these threats really very relevant and might say focused on credit risk. So what do we see? You'll be exposed to more customer bankruptcies next year. You'll probably be forced to sell on credit to more uncreditworthy customers, which may sound like a kind of a unkind comment, but I think it's the reality of the situation. You'll need to do that to generate adequate revenue. What's adequate revenue? Well, it'll vary by company, but you'll have a sense at your organization. But I don't think anyone's planning to accept a 5 or 10% or greater decrease in revenue in 2022 at this point in time. So there's going to be pressure to sell to higher risk customers. And what makes it a little tougher is your credit ratings are less accurate, for want of a better term. Since the financial condition of companies is changing so rapidly, it's difficult for the credit bureaus to keep up with the changes, update their rankings to reflect a true financial rating. So the data you're working with is going to be more flawed, more out of date. So with all of those developments, those threats, those adverse trends, how, as a manager of credit and a manager of the receivables asset, how are you going to generate adequate revenue, yet avoid severe cash shortages that come from customers paying you very late or not at all, and then catastrophic bad debt, meaning much higher than what would be considered acceptable. So that's kind of sets the table. That's the challenge, which brings up the need for what I would call proactive credit management next year. Clearly, to control the credit risk and bad debt loss, not eliminate it, control it. Same thing with the severe AR delinquency and its resultant impact on cash flow. You want to minimize it. Can't eliminate it. It's going to happen. But how can you minimize it? At the same time, promoting revenue in accordance with your company's tolerance for credit risk, which hopefully has been defined. If not, press on that early in the year. So everyone understands the risk that's going to be borne. And so when a customer goes belly up, we don't get a lot of second guessing and a lot of finger pointing. And, we're talking about customers, but remember, this can also affect vendors as well. So, if a couple key vendors go bankrupt, that could really impact your company as well. So as in addition to looking at customers' creditworthiness and financial health, need to do that for your key vendors as well. And then finally, there's a lot of threats that are going to affect a lot of companies, but there's also opportunities. And one of them is onboarding new customers quickly so that you preempt other suppliers. And we'll talk about that a little bit more. But I think you'll agree there's significant need for enhanced, timely, proactive credit management next year. As I mentioned earlier, in addition to threats, there's always opportunities. And I alluded to this just a minute ago. New customers. Companies are going to be hungry for revenue. your company will be hungry for revenue. Your competitors will also be hungry for revenue. So getting to these new customers, signing them up, and starting to do business with them fast is a key competitive advantage because you'll preempt the competition. Most companies, if they're looking to find a new supplier for a product or a commodity or a service, they're not looking for 4 new suppliers. They're looking for 1, maybe 2. So be number 1. Get there fast. And a fast quality credit vetting process can do that and put you in a nice position, be a competitive advantage. And how fast is fast? Well, Hackett's world-class performance is 2 days, 2 work days to arrive at a credit decision. Oh, that's pretty fast. And if you can match that, you can do that, you will be the first supplier ready to do business with a new customer. The other opportunity here is in a risky environment, being able to sell to financially weaker customers, a higher risk environment, but sell to it smart way. Control the risk, monitor the risk, limit the risk, and reap incremental revenue. I know this requires excellent credit control capabilities, which is not only process, but also the policy and automation. And don't be afraid to remind people, for these higher risk customers, you should be selling at a higher price and a higher margin. A risk, the economists would call it a risk-adjusted margin, which, is valid. Nice way of saying it, but higher prices. So you can make money and better withstand any credit losses that come. So as well as the threats, a couple of nice opportunities here that enhanced credit control capabilities will enable you to exploit. All right, let's talk about the solutions. And as I mentioned earlier, some of them are process solutions. Clearly, there's automation solutions. But I think as we look at the threats and the opportunities, I think we can agree that both of those developments imply heavier workloads for the credit department. You need to update more credit limits. You need to update them more frequently. You need to onboard new customers much faster. That's greater overall workload, and sometimes the peaks of the workload get a little higher. So what are some of the solutions? Well, number one, update your credit assessments and subsequently the credit limits, ideally of all your customers, ASAP. Now, that's a big task, but certainly your larger and medium-sized customers. If it's been a year or more since you updated the credit limit, I'd refresh that in credit investigation, refresh that credit limit of your large and medium-sized customers, excluding, of course, your bulletproof credits. If you're selling to Apple, Microsoft, you don't need to update their credit limits. You're pretty good there. But for most of the others, update them ASAP, and so you know what you're dealing with. And then you'll probably have to update them a little more frequently than you have. Typically the annual update, well, that's probably not good enough for those that you've identified as being more risky. So that's number one, what you can do. Put you in an informed position so you can control the credit risk. But it's a lot of work. The other thing is make sure your order hold that's triggered by credit conditions is operating the way it's supposed to, automatically, fast, and triggered by not only over credit limit conditions, but also a delinquency condition. Receivables over 30 days old, 20 days old, whatever. Do yourself a favor and make those thresholds and those triggers dollar tolerant. So if a customer's $3 over their credit limit, you don't want those orders being held. Put a few percentage point variance in there before the order hold's triggered, things like that. But it's got to work. It's got to work fast. It's got to work 100% of the time. So those are two controls right off the bat that will pay dividends. Next one is accommodating some of the newer methods of payment. Think about it. In receivables management, in credit collections, you're asking your customers to do something. And what is that? Well, pay your invoices on time and in full. Fine, that's nothing wrong with that. But when you ask somebody to do something, if you can make it easier for them to do that, you're ahead of the game. And if more and more customers want to pay with electronic methods, not print a paper check, put it in the mail, some sort of electronic payment, and there's a range of those. Some have been around a long time, ACH, but there's more and more new ones emerging, labeled fintech, digital payments, frictionless payments. I mean, there's many names. Ultimately, you're going to have to accept these payments in these modes. So why not sooner rather than later? Get ahead of the curve. Accommodate your customer's preference. Make it easier for them to pay you. The other thing that needs to be addressed is make sure you have efficient, robust work from home capabilities. There was many announcements this past summer. Companies resuming full office occupancy on January 2nd, 2022. And in the last few weeks, most of those have been suspended, pushed back, and all. And no one can guarantee this is going to be the last time that happens. So, plus employees kind of like working from home at least part of the time. And with the competition for talent, here again, accommodate your workforce. Just like you accommodate your customers, accommodate your workforce. Work from home, critical capability to do that. And then the other solution, automate. Automate the end-to-end credit vetting and control processes. Since the threats we've discussed are going to increase the workload, well, how are you going to handle that increased workload efficiently, but also fast? Well, streamline your processes, but ultimately the solution comes down to automation. And there's many solutions out there, and they're here today, they're up and running. Not a big deal, not a big deal. So those are some actions you can take. If we get a little more granular here on some of these actions, take small steps. Go to an online credit application. Well, again, easier, faster, easier for your customers. Have the capability to automatically import credit bureau data from D&B, Experian, for your credit evaluations. Automate the credit scoring. Customize it to those factors you value most highly, but automate it. You can even extend it into a recommended credit limit automatically, which of course you would review or somebody would review. And then for those credit limits that are large and require additional signatures and approvals, boom. Make sure you have a full-featured workflow that routes it through the delegation of authority. And again, the credit limit update, automate that. Automate the order hold if it's not already automated. We talked about that. And then since the workload and importance of the credit activity is increasing, Nice to have credit scorecards that kind of track the activity, and most importantly, track your backlogs, right? How many credit apps are awaiting decision, and how old are they? And it's also nice with the prevalence of analytic packages out there. Nice to get an overall look at the credit risk of your AR asset. All that's possible now with mainstream automation. And what is that automation? What is that technology? Well, at a very high level, the best technology is artificial intelligence powered, called digital credit. You've heard these terms, has artificial intelligence, natural language processing, machine learning, a host of things. Most of them integrate very nicely with your ERP, which is the single source of the truth. Another capability that help you a lot is called a digital assistant. And the name suggests its function pretty well. It assists you. It can do reporting. It can engage and assist customers, particularly if you have a customer care portal. Walk them through the operations. Here's where I get the invoices. Here's where I get a statement of account. Here's how I can make a payment, register a dispute, and perform a lot of repetitive tasks. And the end up of all this technology, faster credit decisions, very high level of automation, and better credit decisions. You know, the advantages of AI-powered digital credit, well, we've kind of alluded to them already. You know, that online credit app is really very nice because the potential customer can't submit it until it's completely filled out. So instead of you receiving a partially completed hard copy credit app that you have to bounce back to the customer and say, hey, you know, you got to fill it out, whole thing. That eliminates that. The automated gathering of information we talked about already. I mean, it's automated and it's fast. Another nice feature is verifying of key information, like does this company have a business license? What's its sales and use tax certificate number? Is it on the OFAC list of banned companies? Things like that. And as I mentioned earlier, the automated scoring and a recommended credit limit. If your operation in credit is 100% manual, you can see labor savings of 70 to 80%, which is huge. All right. So those are the capabilities and I think prudent responses to the threats and opportunities that we'll see next year. Let's look at a couple case studies. One, a building materials supplier. Now, if you know anything about that industry, they sell to contractors, which are charitably referred to as thinly capitalized, which means they don't have a lot of money. So late payments, default is a big problem. But, you know, that's the industry. If you don't sell to those customers, you don't have a business. So it's a challenge. It's a challenge. So managing the credit risk is a big challenge, but also the need to onboard them quickly. This particular company was growing fast, looking to onboard customers. Customers wanted their product, which is great, but it was taking them 2 weeks to make a credit decision. So with Emagia's digital credit automation that has the capabilities we've discussed earlier, they were able to bring that 14 days down to 4 days. Big improvement. Big improvement. And the automated resale certificate verification was critical because it keeps you out of a lot of sales tax problems. Another one, American Heart Association, nonprofit. They actually have started a nice little business on the side, selling CPR equipment, classes, education, things like that. Here again, it was taking them 2 weeks to make a credit decision. Did the same thing as the building supplies, deployed Emagia's digital credit solution. The digital signatures are a big thing too. I didn't mention those, but man, makes it a lot easier. And here again, the credit decision cycle time went from 2 weeks down to 1 to 2 days, which is Hackett world-class performance. Big help. All right. So what do all these capabilities and improvements and actions do? Well, faster turnaround of credit apps, which enables you to take advantage of opportunities out there, increase productivity, which is critical since your workload is going to go up in the higher credit risk environment. Enables you to maximize your revenue while controlling the credit risk. And of course, for your e-commerce orders, fast credit approval enables straight-through processing. So if you look at that value chain at the bottom here, better customer experience, controlled credit risk, ultimately yields a greater cash flow, higher revenue, higher profits. So what's our conclusion? Credit function is going to be tested in 2022. A higher risk environment, the need for speed to compete, the need to be able to work from home, and an effective credit risk capability is going to be required. And yes, there's process things you can do, but a lot of the way to improve your capabilities is through automation and digitization. Questions? Akshay, any questions come in?
Sure, John. Yeah, thank you very much. We do have questions coming in. Let's pick up the first one. Okay. What kind of a challenges are we foreseeing in 2022 for key credit management?
I think the major challenge is going to be the credit risk from the factors that we cited in the first few slides. A reduction of pandemic assistance, a reduction of loan, mortgage, forbearance. Those are the two major things. You're going to be post-holiday, and then the interest rates going up. Now, interest rates are very, very low now. And the Fed said 3 interest rate hikes, probably be a quarter point. Doesn't sound like a lot, and if you're paying 3% now, doesn't seem to me like it's a big deal to pay 3 3/4% by the end of the year, but it will affect some companies. It will hurt them, and and a certain percent of them are going to be pushed into bankruptcy. So those are the major.
Another question from the same participant. What action should we be taking for 2022 for having a proper credit management in place?
Well, I talked about maybe 6 or 8 different actions. But I'd say number one is update your credit limits of your larger customers as quickly as you can. And then secondly, I think you need to automate. You need to be able to accept these fintech payments. You need to be able to deal with an increased workload driven by a higher risk environment. You need to be able to deal with that. And not only an increased workload, but the need to turn around things faster. And for most companies, some degree of automation is going to be required to achieve that.
Thank you, John. We're just having, I think, less than a minute to go for us. Let's take one last question. What are the potential benefits from automating most credit control functions?
Well, it's speed of response, risk, get a competitive advantage in securing new customers. So that's probably the major development right there.
Thank you very much, John. We're just on top of the hour here, so I'd like to thank all the participants for joining us for today's masterclass. As we get into a new year, I would like to invite you all for our next masterclass session, which is going to be on 6th of January, 2022, at 8 a.m. Pacific, again on a Thursday. The topic for our next session is the power of single accounts receivables ledger. So that's going to be a topic. And in case if you do have any questions with respect to today's session, you can write it to us at info@emagia.com. And we all look forward to seeing you there. Please go to the website on Emagia Masterclass, and we look forward to having your participation. Thank you very much, and Merry Christmas to all of you, and wishing you all a Happy New Year. Thank you very much, John.
Great. Thank you so much. And we do encourage questions. Happy to receive questions. Even a week or two from now, if you think of something, please don't hesitate. Thank you.
Thank you. All right.